So you're looking to turn your big idea into a company or raise money for your startup, but you don't exactly know how all of this works. In this video, we're going to explain everything you need to know about startup funding and how raising money for companies actually works. Let's set the stage. You have an idea. Well, you have lots of ideas. Most of them go nowhere. But one weekend, something does. An idea you've been playing around with turns out to be a really good idea. So you start building a prototype. A few weeks later, things are looking good. This could actually go somewhere. But you don't know what to do now. Your prototype works, sort of, but you need some money to rent a server, build your website, and actually take this idea somewhere. You need to raise money for your startup. Stage 1. Your prototype is a diamond in the rough, but it barely works and you need a little bit of cash to get going. This first stage of funding is the idea stage. Your expenses are the lowest at this stage, but so is your ability to raise money. In this round, you have 3 options: friends, family, and yourself. For this process, you won't be taking out any loans. All funding will be in exchange for equity, or part ownership of the company. At the very beginning, since the idea is yours, so is all the equity. You own 100% of your project. But as you raise more money in exchange for partial ownership, your percentage ownership of the company goes down. This is called dilution. Since your stage 1 expenses are smaller, website hosting, a server, business registration fees, and some money for marketing, your funding will be small as well. Between yourself, a couple of very nice friends, and your wealthy uncle, you manage to scrape together $10,000. To keep the math simple, all parties agree to invest $1 per share, and you agree to give away 10% ownership for their generous contributions. Since your first investors now own 10% of the company at a price of $10,000, that makes the other 90% worth $90,000, valuing the company at $100,000. This is your valuation, or the total value of your company as represented by the number of outstanding shares multiplied by the market price of those shares. Stage 2. It's been a few months since your first round of investment. Your project has been hosted on a server, you got the website up and running, and your marketing is starting to pay off a bit as you have your first 100 users. Congrats! You see where this big idea is going, and it's time to make things happen. You need other programmers to help build more features. You need someone dedicated to the marketing and advertising. You need someone to help you make the product's design less generic. You need more money. Now that your idea has proof of concept in the form of users, you can go after real money from professional investors. Welcome to the seed stage. You are out pitching your idea to investors and chasing your first big investment into the company. You have 2 options: angel investors or seed capital. Angel investors are usually single investors who invest their own money into companies. These people are usually successful founders or businessmen themselves and are looking to help fund the next big idea. Angel investors can be harder to get in contact with, but often will get involved with both their expertise and money in an idea they like. Seed capital investors are professional investors who invest other people's money into startups. These type of investors tend to be easier to find and can offer larger piles of cash. However, you are likely one of hundreds of investments for them, and you won't receive as much attention as with an angel investor. So, you talk with several seed capital firms. Some of them like your idea and some of them don't, but you don't get any traction right away. A connection of yours just happens to know someone who works at an angel investment office. This investor is a pretty big name. He made a fortune selling his own company many years ago, and now he has a meeting with you. You fly out to his office in San Francisco, confidently pitch the idea, and it goes okay. He asks you many questions, only some of which you have the answer for. You leave not knowing if you just blew your best chance. The next day, you get the call. The angel investor saw something in your presentation, and this company has a future. You have your first real investment. The angel invests $2.55 million into your company for a 17% stake. The angel's ownership doesn't come from existing shares. Rather, the company issues new shares to the angel in an amount equal to 17% of the company. Therefore, the percentage of the company you own is diluted, but the value of each share and the aggregate you own is increased. Your company is now worth $15 million. Stage 3. It's been 9 months since your seed round, and you are a busy CEO. You went on a hiring spree immediately after that fundraising, and now you have 11 other people working for you. The product is growing fast. You have almost 100,000 monthly active users, and you consider it a light day when you have to work only 12 hours straight. It's time to bring in some real rocket fuel and grow the company faster and bigger than ever before. It's time for the growth stage. In this stage, you are an established company with a live product, users, revenue, and employees. You're after the big investment money now. Enter venture capitalists. Venture capital investors are a bit like seed capital investors in that they are professionals who invest other people's money as a fund. These guys are tough, want big returns, and have big wallets. You spend a few weeks shopping around for the best investment and best partners, and you settle on the perfect venture capital firm for your company's niche. This round clocks in at a staggering $6 million for 8% of the company. You're now officially rich, and your company is valued at $75 million. This investment round, the first after your seed round, is called the Series A. This isn't the first growth round you will raise, however. As long as you're a private company, you will most likely keep raising series funding every so often to keep the company growing, even if you are profitable. The name of the game during the growth stage is, well, growth. You go on to raise a Series B 6 months later, and an even larger Series C 5 months after that. Stage 4. It's been 3 years now since you started this little project. You've become a successful entrepreneur, You are worth hundreds of millions of dollars on paper. Everyone who came along with you has seen incredible returns too, and your business is flourishing. It's time for everyone involved to have the opportunity to cash in on their hard work, effort, and investment put in over the years. It's time for an exit. Welcome to stage 4, the exit. There are 2 routes, acquisition and IPO. In an acquisition, a larger company buys your company in the whole. The details can get complicated and vary by the deal, but usually the founder and investors will receive a mix of cash and stock from the acquiring company, with some form of a retainer placed on the founder to keep him from immediately leaving once the acquisition goes through. In an IPO, your company lists its shares on the public market, allowing anyone to buy and sell your shares. This is usually when most of your investors will cash out their investments in your company. You and your board of directors decide to IPO. You spend months going back and forth with investment bankers and your accountants poring over the details until the day finally arrives. Your little idea has grown through all 4 stages of investment into a true company. You have over 1,000 employees, make $300 million a year in revenue, have a couple million users of your product, and your company is being valued in the public markets at $3 billion. You, the CEO, own enough of the company to be considered a billionaire. The day of the IPO arrives. You ring the bell of the New York Stock Exchange, your shares begin trading at 12% higher than list price, and you are now in charge of a public company. Congratulations. Now you start thinking about how you can help the next stage of small companies make it big, and you decide to become an angel investor yourself. Only on the weekends, though. Now you have an overview of how startup funding works. There is, of course, much more nuance to each stage of startup financing, and each really deserves its own video, maybe in the future. If you enjoyed this type of content and want to learn more about tech and finance, please subscribe. Thanks for watching.